Welcome to Biz Ed Made Simple. This video is aimed at Cambridge, IGCSE and O-level business, but we're looking at Unit 5, the scary one. Finance. We're going to cover cash flow forecasts. We're going to cover statements of financial position, liquidity ratios. In fact, we're going to be covering everything you need to know for your IGCSE exam. They're some of the hardest concepts, but I've really focused on trying to explain it so you can just sit back, relax, watch a few silly stories, and by the end of it, you should have no question that you can't answer. If you find the video useful, don't forget, like, follow, and share. It really helps me out. Any questions that you've got at the end of it, write them in the comments and I'll get back to you as soon as I can. Hope it helps. Enjoy. Welcome to Biz Ed Made Simple. In this video, we're looking at a popular topic that trips up a lot of people. We're looking at the need for finance and the main sources of finance. You can see everything on my screen that we're going to cover in it. Let's get down to it. So the first thing is, why do businesses need finance? Well, they need it for startup capital. It costs money to create a business from scratch. You can see a hair salon might need 10,000 to buy the chairs and the mirror and so forth. So that's a reason why they're going to need money. Another business might need it to expand. They may have been open for a while, but if they want to get bigger or open a new shop or something like that, they're going to need money to do that. Another reason is replacing an asset. If your equipment that you've got, the asset, if it be a taxi company, if their taxi gets old, then they'll have to replace it. So replacing that asset is another reason why they might need finance or money. Investing in technology. They might need to modernize their company, get it up to date with the AI technology and robots going into it, automation. All of that would cost money to do it. And then finally, they might need it for the work, well, they will need it for working capital, which is paying the day-to-day bills. Now, I've done a whole other video on this section, so I'm going to put a link up here. Have a watch of that. Okay, we then need to break it down. It's commonly broken down into short-term versus long-term finance. I find this section a little bit irritating, but essentially, short-term finance is money that is needed for less than 12 months. So they need it urgently and they expect to be able to get that back in a different way or not need that money tied up for longer than 12 months. Long-term finance, they expect they need to spend some money and they're not going to turn that back into money for a long, long time, well after 12 months. So that's short-term and long-term. It's not the most comfortable of definitions there, but good enough for us. So if we look at it like this, we've got the different ones we're going to be running through where we can break it down into short-term, long-term, internal or external. We'll come back to the words internal or external, but that's going to be hovering on the video screen as we go, and we're going to be covering all of these different things. As ever though, because it's my video, I'm going to love a silly story, so let's get into the silly story to explain all of the rest of the things. We're going to start off with cautious Carla. Now, Carla has always dreamed of running her own cafe, bar style thing in the center of town. But she, although she's a bit of a risk taker because she's starting a business, she's errs on the side of being cautious and she refuses, she always has done in my silly story, to borrow money from anyone. She likes to be independent. She doesn't like to borrow money for banks, investors, mum, dad, no one. So she's going to be trying to open this cafe all with her own sources of finance. Okay, let's look at why she needs some money. So the first reason she's going to need some money is to open the cafe. We just used that key term, but she's going to have startup costs. She's going to have to buy furniture, oven equipment, all sorts of things. Now, over on this part of the screen, below me, you should be able to see that when choosing a source of finance, we should think about these different things. The size of the business, well, it hasn't really started, the legal form of the business, the amount that she requires, how much money, the length of time that she wants that money, is she going to pay it back? Has she got any existing debt or loans? The cost of borrowing that money, if she is borrowing it, and the purpose, what's she putting it to? And then she wants to think about this little post-it note of internal and external. Now, she is only going to be using internal finance though, because that means she doesn't want to borrow from anyone. She wants all the money to come from herself. So what should she do here? Well, she thinks about it and she says, I don't want to borrow from anyone. I want it to be internal. So she goes to her owner's savings, her own personal savings there. And This is providing that she has some, and she does. So she breaks open a personal piggy bank to start this business. The advantages of that is that she doesn't have to pay any interest to anyone. She doesn't have to pay anyone back. It's her own money. She's just using it to start her business as probably a sole trader at this stage. This also means she keeps full control over her new business. She doesn't have to owe anyone any favors or ask their opinion, no investors, not even a mum and dad, because she's used her own money. And of course, because it's her own money, it's quick and simple to arrange. She doesn't have to ask anyone. She just says, my money, I'll spend it on what I want. So she does that. The disadvantages though, well, it puts her own money at risk. If the business fails, if her cafe doesn't work, well, she doesn't get that money back. She's got an opportunity cost there that she can't spend it on something else. She can't open another business or go on a holiday, those sorts of things, because she spent all that money on the business. It's also a big problem. It's limited by how much savings she's got. Some people don't have any savings, so they can't open it with owner savings. If she's got 20,000, well, that's the limit on how much she can borrow. She can't borrow. That's the limit on how much she can use. If it's not enough, then that's it. She can't use it. Then we move along in the story. Now, Carla needs money. She's not been handling things very well in the restaurant, just to start with, in the cafe, just to start with. She's been ordering a lot of inventory. She's been buying lots of coffee beans. And to keep her customers happy, she's been running tabs. And she'll say, yeah, no problem. You can pay me next week and those sorts of things. But that's putting her in a bit of difficulty because, of course, she has to pay for things. She has to buy coffee beans. She has to buy toilet roll for the toilets and so forth, and she's been struggling to pay her day-to-day expenses and got low working capital. So she has a think, she goes through the list, what can she do? She doesn't need massive amounts, but she does need to be on top of her daily money. So she thinks, you know what, I'm going to sort this out. I'm going to manage my working capital better. How does she do that? I'm going to go to the disadvantages first. Well, she says, I'm going to reduce stock. I'm not going to order 700 bags of coffee because that's just going to sit in the inventory in the storeroom, blocking the storeroom, and it's not going to turn itself back into money until the customers buy cups of coffee. So she's going to reduce the amount she's going to buy, maybe just-in-time inventory management from Unit 4 in most syllabuses. She's also going to, but that's a problem because if she runs out, because we're doing disadvantages, if she doesn't have enough, she's going to run out and upset the customers. She's also decided no more tabs. I'm going to ask the customers, sorry, you've got to pay straight away. When you drink or eat here, you have to pay. You can't pay me at the end of the week. Good, it's going to have more cash coming in faster, but you're going to upset them because they would have been used to paying at the end of the week. She could also risk delaying payment to her suppliers. The people who buy the coffee, she could say, yeah, I'll pay you, but she actually pays them a week later. All that would help her have more cash to spend, more working capital there. Watch the video just to check on that. The advantages of that, because I did disadvantages first, well, that would free up cash quickly. It's pretty easy. She doesn't owe anyone any money. It just means she's got more cash available. It improves the day-to-day cash flow. And of course, there's no interest because she's not borrowing from anyone. Let's go on in the story. Now, time goes on, Carla's doing well, but she needs money to renovate her kitchen. Maybe a couple of years have gone by and she needs a brand new shiny oven. And they're expensive ovens and she thinks, where am I going to get the money to buy this oven? She checks back against her factors to consider how much, what's she putting it to, and she has a think, you can have a think as well, and she decides, I don't want to borrow from someone else, I know what I'm going to do. I'm going to sell an unwanted asset. Because actually, she's got an old oven. Now, it's not entirely broken, we'll say in my story. It'd be good to have two ovens, but the old one was fairly small, and maybe she can sell that asset, the old oven, to buy the new one. So that's what she does. The advantage of selling the old oven and using that money to put it towards a new one is it generates cash without borrowing. She doesn't have to ask anyone for any favors. She just sells her old oven. It also frees out some space. It clears out the old oven that she's not really using and she's not too excited about, and that's a good thing for her business. Again, because it's internal, she's not borrowing from anyone. She doesn't need to repay with any interest to anyone. The disadvantage is, though, of course, it's only possible if she's got a spare old oven. If the old oven's broken, well, you don't get any money for it. So it's not for everyone. You have to have an asset that's sitting around that you can liquidate and turn into cash. Often the amounts are fairly small that you get, because how much money are you really going to get from this old oven? And of course, it may take time to find a buyer. You've got to put an advert out there and hope that someone is going to buy it. I think finally in this section, we now have Carla is doing really well, but she wants to expand. She's making good profit, but she wants to create an outdoor seating area. So she has a think, what source of finance? She doesn't want to borrow. She only wants to use internal sources of finance. So she goes down her list and she says, okay, I'm going to use retained profit. Now, this isn't her owner savings. This isn't her own money now. The business has been running for 3 or 4 or 5 years. And over that time, we would hope, not only is it been like covering its costs, it's been making money. And in the business bank account, perhaps, particularly if it's a private limited company, it should have amassed some money of its own. Well, that we would call retained profit. Well, then use it, of course. If she needs money, rather than using her own personal money, she can use the business's money, the money that's been left behind. So what she does is she can spend that to buy the seating area, and the advantages of that is it's a completely free source of finance. You're not asking anyone for permission. It's the business's money, so you don't pay any interest either. The disadvantages, well, that's not available when she just started. It takes time to build up retained profit. Also, it reduces what Carla can take out as personal income. If she spends it all on refurbishing a kitchen, then she's got less to take out of the company and give to her own bank account and look after herself. And again, the same problem that we can put for most of these. Maybe it's not enough. If she's only been open for a year, it might not be very much money at all. So it's on the proviso that she's got enough retained profit to use it. Now let's go for a second silly story and introduce another character. Now I'm going to introduce Risky Ryan. Now Ryan is a builder, but he wants to start his own construction firm. However, unlike Carla, Ryan loves taking risk, and he has absolutely no problem borrowing money from other people. He's quite happy to do that, and he'll pay them back when he can. He's very casual with those things. So for him, he's all in favor of external sources of finance. He does not mind borrowing, whereas Carla wanted internal sources of finance, money that she's generated herself. He doesn't mind borrowing. So let's get into his story. Well, the first thing, Ryan needs money again to start up his construction firm. Not massive amounts to start, but he needs about £15,000. But he's got no savings. Unlike cautious Carla, he's got absolutely nothing. So he goes down this list, where can I get my money from? He looks at all of these different things, he has a think about it, and he says, well, I know what I'm going to do. I'm going to go to the government. I heard about something like this. They give grants. Now, G of grants for G of gives. Yes, governments give money. They don't just lend, they can do that too, but grants are given. It's a great thing. But obviously, they don't just give them to anyone. You've really got to justify why they should give you some money. So he goes off to the government, goes to the town hall, and he said, look, I'm going to set up this construction firm, and I'm going to help people out. I'm going to create jobs. I'm going to make more houses. And if the government's on board with that, if they say, yeah, that does sound like a useful thing, ultimately we could win in this, we will give you some money. So in my story, he was lucky. He promised to employ local people, and they gave him $15,000. The advantage of this, it's free money. You don't even have to pay back repayments, so you haven't even got interest. This is money that is G given, so that's excellent. It also improves credibility and it meets policy goals, you could say. An advantage of that, if you've got a grant off the government, it shows you're fairly reputable because you will have had to have jumped hoops and the government won't just trust anyone. You can also unlock further support with that. If they give you the money, the government's probably going to want to make sure that you're not wasting it. So they'll probably open up some training courses for you as well. Keep connecting, checking in on you, saying, hey, do you need any help? Because they want you to employ the local people. The disadvantages, though, it's often very small. They're not going to give hundreds of thousands in government grants, about 10 to 15,000 euros. It's also a disadvantage. It's very, very competitive. You're not likely to get it. If you want to open up a company that isn't particularly ethical, then the government is unlikely to give it. And lots of people are applying for these grants. Thirdly, strict conditions on use is a disadvantage. We talk about strings attached often. The government say, yeah, we'll give you this 15,000, but you do need to employ local people. You can't then fully just go, well, actually, I don't want to employ anyone. No, you've got conditions to meet. Otherwise, if you break those, you might need to give the money back. Ryan's story moves along. Now, in this bit, he's getting up and running with his government grant, but he's got his first job. He's promised to build something, but he needs 8,000 to 12,000 in bricks and cement, and he hasn't been paid anything yet because as a builder, you don't get paid in advance. So he needs to buy the bricks first. So he thinks about it. Where am I going to get this 12,000 from? He goes down his list, and in the end, he thinks, I know what I'm going to do. I'm going to use trade credit. Because he's been a builder for a while, he's got some mates in there, the people who sell bricks. So he goes up to one of his mates and he says, look, I need to buy bricks. I need loads of bricks, but let's make an agreement. We can write it down if you like, or we can shake some hands. I'm going to make it, but can I pay you back in 6 months' time? Now, you might say, why would anyone do that? But the person who sells bricks would probably have to get used to doing that because many people would be in this situation. He might not like it, but he probably would say yes. And even better, he probably wouldn't charge interest because it's in his interest for him to be in line with Risky Ryan. Because if you sell bricks and Risky Ryan's a building, it's a good relationship for a brick seller to have with a builder. So they form a relationship and he says, okay, you can take the bricks now and pay me in 6 months. The advantage of this, you don't pay interest typically if it's on time. Unlike a bank that we'll come to would charge you interest, his mate, the brick seller, wouldn't charge him interest. You can match cash outflows to job timing. So by that we mean that he can pay for the bricks once the customer who wanted their house built has paid him. So he wouldn't have said in a week because he wouldn't have been paid yet. So he said 6 months because he thinks the house will be built by that point. It's quick to arrange with known suppliers. They'll probably get caught up in that deal. Next time, he won't have to negotiate 6 months. He goes, same again? Yeah, same again. So it's often pretty quick. The disadvantage, you probably won't get away with early payment discounts. These brick companies will probably give a discount if you do pay straight away because they really want to be paid straight away for their working capital. So you would miss that. If you don't pay them after 6 months, then you're going to break a relationship and maybe they won't sell you bricks anymore. So they may stop if it's late. No more bricks coming to you. And of course, you can't do this forever. You can't say it's not suitable for long-term funding. You can't say, okay, can I get the bricks and I'll pay you in 17 years? They're going to go, no, I need the money. So we've got some disadvantages. On to the next situation then. Ryan now is needing a van, but he needs 24,000. The van he's seen is £24,000, and he just doesn't have 24,000 early on in this in this business. So what does he do? He goes down his options, he looks at those, and he says, okay, I'm going to buy it with hire purchase. What does that mean? Well, it means that you buy the car, but you pay it off the van, but you pay it off in installments, not just all at once. You drive it away. It is your van, but you don't have to pay it all at once. But they come with some conditions here. The person selling the van, the company selling it. So it would probably start, he would need 2,400, we're going to say. These would probably be the typical conditions of buying a van. He'd have to pay outright 2,400 with hire purchase. Then he would need to finance, pay off the rest, 21,600, over 60 months. So that would mean he's paying off 418. This will be very, very useful for your cash flow forecast. Watch this video in another section if you're not sure on that. But that would be a total paid, including in the end, 27,456. So although the van only cost 24,000, he ends up paying 27,456. What's the advantage of this? Well, that's fantastic for helping out with your working capital. It spreads the costs out in installments. It also means it is his van at the end of it, and even you could argue before, it is his van. By the end, after 6 years, or 60 repayments, sorry, that is his van. And it's quite nice that it's predictable. It's 418. That's useful when you're doing cash flow forecasts. The disadvantages, though, he has to pay 3,420 more than you would if you just paid the cash up front because of the interest on the payment. Secondly, if you don't pay it back, if you miss a payment, well, then you've got a risk. That company's going to take the van back, and if you haven't got the van or you damaged it, then you can be getting yourself in all sorts of other problems. So you're under risk there. And the worst bit, even if the van breaks after a year, you still have to keep paying for 60 months because that's the amount you have to pay. So very, very difficult. Next in the story, Ryan's business is going well, but he now needs a large digger, and that's 70,000. So he goes through his factors, how does he decide, and he comes across this option. He says, well, I'm going to lease it. Now, seems a bit similar, but it's not the same as hire purchase. In this one, is essentially, it's kind of like renting, but he is therefore going to pay a monthly installment on this, but he's going to pay it over a long period of time. He's going to commit to it. Unlike renting, which can be fairly short term, it's long-term commitment to renting where he has to pay 1,300 every month. But unlike hire purchase, it is not his tractor or whatever that thing is. The never will belong to him. So he would have to draw up an agreement with this company, the leasing company. Okay, I want this for 3 years and I will pay you 1,300 every month. At the end of 3 years, he can either keep going with that or he can say, I don't want any more. But if he doesn't want any more, well, they take the tractor back off him. So it's just a way of not having to pay the 70,000 outright, but he does have to pay 1,300 per month. So the advantage of this is no upfront payment. Very good at helping with your cash flows. The maintenance is often included in that. This time, unlike the car, if it breaks, if the tractor breaks, that's probably up to the company that's leasing it to you to have to fix it. So you don't have to worry about the maintenance so much. And if the tractor, you say, well, this is a bit old, then you can get an update because you say, well, I'm paying 1,000. I don't want to be tied to this old one. There's a new one that's just come out. Can you swap it? And you can do that. So you can keep up to date with the new equipment. The disadvantage is, well, it's a higher total cost over time. You're paying 1,300 over the course of 3 years, and you don't get anything for it other than the use of this tractor thing. The third disadvantage is, you're tied in even if usage falls. Because you've had to have committed for 3 years, if after 2 years you're not really using it very much, well, tough. You've got to see out the contract that you've signed up for, the leasing contract. Next part of the story, Ryan's van breaks down and he needs an emergency repair. This van that he bought on hire purchase, he has got 1,000 on it. Now that's not a lot of money, but the problem is he's not actually at this point in my story managed his working capital very well, and he's only got £500 in his business account. But he needs to fix the van straight away, otherwise he can't get to work and do various things. So he has a thing, I'm short here, I'm €500 short. Where am I going to get this from? But I'm not short for very long because money's going to be coming in next week. So what do I do in the meantime for this 500? Well, in this case, overdraft is a fantastic choice. What is an overdraft? Well, it's set up by banks and you can ask for it. Most of the time they'll give it you automatically, but if not, you can ask for it. And they say, will you let me spend more than I've actually got in my bank account? Sounds crazy, but they will let you do that. So if you look at this machine here, this seems bizarre, but it would say balance. How much money have you got in the bank? 500, but available to withdraw 1,500. In other words, they will let you go to minus 1,000. You've actually got 500, but they'll let you drop down to minus 1,000, letting you go there. Okay, what's the advantage of this? Well, it's fast and flexible and easy to cover short gaps. You don't have to ask anyone. You just type in the ATM like that, and instead of getting out 500, you get out 1,000. And the bank balance next time will show minus 500. So no need to call anyone, quick and easy. The interest is only on what is used. So if you went down to minus 500, but you were only there for a day, you would have to pay interest, and you'll see that's quite high, but you'd only pay on the minus 500 for the period of time of 1 day. So you want to use it for short term. It's simple to draw down and repay. It's very easy to do that. The minute he gets paid, if he gets paid the next day, that money goes straight back up again. No dealing with anyone, nice and simple. The disadvantage, it says, the interest is high. You do not want to stay in your negative numbers for very long. So you'd be using this over a short period of time, a week, maybe 2 weeks, but interest is high if you're going to stay in negative numbers. It can be another disadvantage to the bank. You might just pull it away. They might just say, no, you're not having an overdraft anymore. So you were relying on it and the bank says, no, we don't want to do that with you anymore. We don't trust you. And the main thing, it's only for small amounts. You cannot go with overdraft to minus 17 million. It will be small amounts they'll allow, and you don't want to do it for long periods of time. Next part in the story, Ryan now is getting bigger and he wants to run several projects at once, but he needs 100 to 200,000 for this because he needs to hire more teams and buy big intensive scaffolding. He has a think, where's he going to get the money from? And at this point he says, well, I should have gone there earlier. I'm going to go to the bank and I'm going to borrow. I'm going to have a bank loan. So how does this work? He goes to the bank, he has to show maybe a business plan, and he says, I would like to borrow from you 150,000. They then would negotiate some terms, but in this one they said, okay, you can borrow 150,000, but we're going to put 6% APR, don't worry about the term, but that's interest, compound interest it would be for those technical ones, but don't worry if not. So, and they'll say it'll be 6% interest if you want it over 5 years. Well, what does that mean then? He borrows from the bank £1,500, but banks don't just do it to be nice. They're a business, they want to make money. So they say, well, if you do that, if you borrow 1,500, you are going to have to pay us back 2,900 every month for 5 years. If you think about that, go, that doesn't add up to 1,000. If you pay 2,900 for 5 years, every month for 5 years, you end up paying back 174,000. So you've paid an extra 24,000, which of course is why the bank does it. The bank makes 24,000 pounds out of you. The advantage of that, well, it's great to get large amounts of money in one go. They will lend you fairly large amounts of money. It's multi-year term matches, that sounds complicated, but that's good because you can take it over a long period of time. So if he needs this project and he knows he's not going to be paid for a couple of years, well, that would work okay with that, and then you've paid it off. You've got a fixed schedule. Again, that's very, very useful when sorting out your cash flow forecast to know it's a fixed cost. You know every month you're going to have to pay 2,900. The disadvantages, though, you end up paying back more. We've got the interest, that's 6%. You end up paying back 24,000 more than you actually borrowed. You may require collateral. Often you'll require. Now, what does that word collateral mean? They're not just going to let Ryan walk out with 150,000. They're going to say to him, okay, you can borrow this money, but what have you got to put against it? So he might have to put a house or his car or something like that up, because they say, if you don't pay it, if you don't give us back that money, we're going to take that asset off you. We're going to take your house off you because we want to make sure you pay. We don't want to hear, oh, I haven't got it, I can't pay it. Well, we'll take your house and then we'll sell that to get our money back. So that's called collateral. So high risk. It's very risky if profits are lower than planned, because if you default on those payments, the banks aren't waiting to be kind. They are going to say, I want that money back. You owe us 174,000. We're going to take whatever you had as collateral. They're going to be pretty brutal and damage your credit rating, stopping you from being able to borrow in the future. Next, Ryan now gets even bigger, all going well, but he wants publicity and cash for Eco Homes pilot. He needs about 60,000. So he wants to get all ethical. He wants to do an Eco Homes. He doesn't want to borrow again from the bank though, because he's already got existing loans. He's used quite a lot of these things. So he thinks, where do I get this 60,000? Well, he comes across an interesting one here, and he comes across crowdfunding. Go and have a look on a website. This is a real website here. Lots of my children can't believe this thing exists. But yes, there's like GoFundMe, where he can just go on. This is real. I just took a screenshot. You can go on and say, I'm running a business, but I want to do something. It doesn't even have to be good if you don't want, but will you give me some money to do it? It's a bit more complex than that, but essentially it's saying, I want to do this thing. Will you just give me some money? It's sort of like online begging, as it were. And you can see, so on here, this person wants to build free parking and she's raised 25,000. Again, that's a screenshot, so this really is real. So he could do that. I want to build eco homes to help the world. Hey, who wants to give me some money to do this? To give me some money. Just donate, give. I don't have to have anything back, just give me money. Great if you can get it. The advantage is it, well, you get finance, you get the money, and you get marketing buzz, because you get an audience who's excited about this and they might spread the word on social media. You'll have access to small backers. You'll have lots of people hearing about you and chipping in and giving money. It's useful market validation. It's good to let you know, they're a bit complicated there, but it's good to let you know this is going well, right? This is a good thing that I'm doing. Often the advantage though is, it doesn't say that, you don't have to pay it back. It's given. Not always, we have to be careful with that, but often the money is just given by these people. So it's free money. The disadvantages, well, the biggest one, are you really going to succeed? It's unlikely. Lots of people try it and get absolutely nothing. So yeah, if they can get it, but you probably can't get it. You're going to struggle. Next disadvantage, it takes a lot of time and effort to promote it. Yeah, you've got to be creating a good page. You've got to be spreading the word on your social. Come on, donate, it's great. And thirdly, your ideas become public. If you've got a rival, they might start copying you. So you can't keep anything too secret if you're going begging for money from people. Next, Ryan's doing really well and it's got even bigger now, and he wants to go for a high growth eco estate but needs a lot of money. He needs 500,000. So he again looks at his list, existing loads, the length of time when he's going to pay it back, and he thinks, I'm going to go for venture capital. Now, this is kind of like the Dragon's Den or Shark Tank if you've seen it. Great program. You should, as business students, be watching that. But this is where he goes to an investor, a venture capitalist, and he goes and says, look, I need 500,000. Will you give me 500,000? And as a return from that, I will give you a percentage of the business. You will become a percentage owner, and therefore you will get a percentage of all of the future profits and wealth of the business. That's what happens on Dragon's Den. You can go and watch it. They'll explain far better than me. But what are the advantages of this then? So the advantage is you can get large investment plus expertise and contacts. That's one of the things when you watch the program, you say you're not only getting the money, you're getting my expertise and you're getting my connections with the supermarkets or whoever it may be. Other advantage, you're sharing risk now with the investors. These investors, because they've put this 500,000 into it, they risk their money too, and they're going to want to help you out, so it's not risking that money, so it does succeed. They will help you with all their expertise, accelerate the scale up. They will help you grow more rapidly. The disadvantages though, there will be significant loss of independence. You're going to have to ask these dragons now what's going on. Well, not ask, but they're going to come over, and depending on how much of a share they've got in your business, they're going to be looking over your shoulders saying, what are you doing? Why are you doing that? So you're going to have to answer a few questions to these venture capitalists. There'll be pressure for high growth and high returns. These venture capitalists will want lots of money. They didn't give you money for the fun of it. They're going to want to give you money and get fast money back. So they're going to be putting pressure, going, no, come on, what are you doing? I want another investment, build something else. So they're going to put pressure to make you keep working. And of course, it's going to be the dilution of your shares, the dilution of owners. If you give 10% away, you might only have 90% of all of the business profit and wealth in the future, and they keep 10% of that. Finally, I believe the last one, in this situation, Ryan now has gone really big with the help of the dragons, and he's converted to a public limited company, which have a look in Unit 1 videos or this video if you want to see what a public limited company is, because it's important here. But he wants to plan regional growth, so he needs masses of money. He needs millions of pounds. Well, he thinks about that. Where am I going to get my millions of pounds from? Well, it's not going to come from an overdraft or something like that, small amounts. So he decides upon the stock market. He decides, as he's a public limited company, he's floated, and therefore he can issue shares. Not just sell shares to a dragon or a friend and family, as a private limited company can be, watch the video. He can now sell shares to the general public where the public of public limited company comes from, and they can buy a little piece of his business for a cost. You can sell millions of these shares and therefore raise millions. That's a longer video in itself, but as a source of finance, what's the advantage of that? Well, you can raise large sums of money. You're not going to raise 20 euros with this. This is for large amounts of money, millions of pounds usually. There are no repayments. You don't, when someone invests in that company, you don't have to repay them. That is money they part now, a tiny, tiny owner in your company. You don't repay them. But because they own part of the company, then they will get payouts from the company, and those payouts will be dividends. So if you want to pay out and you've given away 40% to shareholders, if you want to pay yourself out 100 euros, be far more, but if you pay out 100 euros from the company, 60 euros would go to you and you'd have to pay 40 euros to all of the shareholders as dividends. The disadvantages of that, there'll be some loss of control is possible depending on how many shares you give away, but it's easy as a public limited company to lose track of that, and you might find that you're not in control as much because before you know it, you're not the majority shareholder and you've got a board of directors getting you to do things you don't want to do. Like with the last one, the venture capitalists, the shareholders expect returns. Short-termism, we call it. They are looking for money to turn into more money. They're not really interested, these shareholders on the stock market, in whether you build houses. They just put money in the hope that it will become more money very quickly. So they'll be putting pressure on you to just make more money. And you're absolutely going to have legal and reporting requirements. If you are a public limited company, then you're going to have to be enormous cost as well, declaring everything that's going on and representing it and having annual general meetings and so forth. So that is only for a certain type of company. That ends sources of finance. It was a long video. I hope it helps. As I said at the start, any questions, just write them in the comments and I'll happily help. In this video, we're going to go through everything you need to know about the concept and importance of working capital. It comes up a lot, but it trips up a few children because it's not quite as simple as it first seems. We need a little bit more understanding. So we're going to dive into that in this video. The first thing though, we hope for this question, we want one of those define ones because then we know they're just looking for knowledge and you just need to remember this definition. So the definition to remember is working capital is the capital available to a business in the short term to pay for day-to-day expenses. But that you just need to remember. In this video, I want to explain it to you. So I'm going to show you how I do it with my classes. What I do is I put that definition on the board and they say, yeah, I can remember. I say, okay, can you understand it? Let's put it back on you. If we forget about businesses for a moment and we just look at you coming into school today and we think only about today, what is your working capital? And they look at this definition and they would say, well, okay, my capital. So working capital is the capital available. What capital do I have available while I'm in school? I talk about that. And they say, well, capital, isn't that just money? That's the money that I've got in my wallet. Okay, we'll maybe come back to that. But they say, well, maybe in my wallet, let's say I've got €1. So my capital is €1. And then I also need to think about the daily expenses. What expenses do I have at school? They write a list. They might say things like, pay for the bus fare home, or I've got to buy my lunch. And you say, great, okay, that's a nice start, but it's not quite accurate enough. So I've trapped them there. I then say, okay, we're going to not think about you. We're going to think about a silly story of a boy called Cavit. Okay, what's Cavit's working capital? Well, Cavit has €1 when he comes into school. He has €1 in wallet, and he only has the expenses of a bus fare home. He doesn't have to buy his lunch or anything, to keep it a little bit simpler. And his bus fare home is €2. The question I throw to them is, does Cavit have the working capital to get home? You can have a think about that. Pause the video now. And you're probably going to be saying, no. He doesn't have the working capital because he's only got capital of €1 and he's got expenses of €2, and that's not enough. So he's going to be walking home. He won't be able to get the bus. Okay, but I've thrown you into a trap there because actually we need to think about working capital in a little bit more detail. In this story, I say, well, Cavit's dad is an accountant and he's desperate to explain it fully what working capital is, and you need to know an equation. And the equation you need to know is working capital is current assets minus current liabilities. So we go back to Kavit, and Kavit says, okay, I don't get that. Kavit's dad says, well, forget about current liabilities for the moment. Let's just look at current assets, because you made a mistake earlier. You thought that capital was only cash, but it's not only cash. Capital is made up of current assets. And current assets, they can be cash, but they can also be anything that can be turned into cash in a year. Okay, in my example, we're talking about in a day, but for a business point of view, it's anything you can turn into a cash. Now, in my story, I say that Kavit, in his bag, had a huge, great bar of chocolate, a delicious dairy milk bar, as I've put there, just to be silly. And the dad is teaching a lesson, and he says, well, that bar of chocolate is actually part of your capital, because that bar of chocolate, if you really needed to at school, you could always sell that bar of chocolate. There'll always be a child who's prepared to buy that bar of chocolate. Maybe not full price, but they'll be prepared to buy it. And he says, I reckon you could always sell it for a value of €2. That is kind of like you having an inventory. Your capital, your current assets are made up therefore. You've got €1 in cash, but you've got €2 in chocolate bar that you could convert into cash. So in actual fact, then, he says, you could be able to get the bus home because you've got €3 in capital. Okay. He then said, but what about this current liabilities bit then? That's confusing. What are current liabilities? Well, he says, well, current liabilities are the debts that usually have to be paid within 1 year. And to explain this example, I say, well, Kavit's actually got a current liability that day. So in my silly story, Kavit, he has his chocolate bar, he has his €1, but at 12 o'clock, Big Scary John is coming because he got himself in some debt with Big John, and he owes Big John €3, and he has to pay it at 12 o'clock. We would call that debt a current liability because it certainly has to be paid within a year. It actually has to be paid at 12 o'clock. So if we think about it like that, then what is the working capital of Kavit now? Well, the working capital, therefore, is made up of the current assets minus the current liabilities. So Kavit's working capital is €1 for the money. He had €1 in cash. Plus, he had the inventory, the asset of the chocolate bar, which was worth €2. So it was 3 minus the current liability. And the current liability was the debt he had to Big John at 12 o'clock for €3. So his working capital, in fact, is 0. He doesn't have any working capital. And therefore, he won't be able to get the bus home unless he gets some more money off his dad. There we go. So that's the concept of working capital. It's not quite as simple. We need to also understand this equation, current assets minus current liabilities. Final thing to talk about then is, why is working capital so important to a business? Well, we think about that definition again. Working capital is the capital available to a business in the short term to pay for the day-to-day expenses. Well, so why does a business now need working capital? Well, because it's got day-to-day expenses. It needs to pay for wages and suppliers and things like that. It has those things. If it doesn't have working capital, it can't pay the current expenses that it's got. Second thing is, even if you say, well, I've got just the right amount, always new expenses appear in business when you're running the unexpected. The lorry breaks down. You're going to need a little bit more cash to fix it quickly at the side of the road. So working capital is also necessary for the unexpected things. And then finally, working capital is so important to have a good reputation if you're going to want to borrow money from a bank or something in the future. Because if you don't have working capital, you won't be able to pay your short-term debts. And we would say that you would be illiquid. You don't have the ability to pay your short-term debts. And banks want you to have a history of being liquid, not having a lack of ability to pay your debts. So working capital is important for those three things. That's it. That's working capital explained. Hopefully it cleared it up. Any doubts, write them in the comments, and don't forget to like and follow. In this video, I'm covering cash flow forecast. Now, there's a lot of videos out there, but it's worth it because it's such an important one. It comes up in so many exams, so many points available for it. But better than that, I reckon everyone should know how to do a cash flow forecast because it's a great way of managing your own personal finances. Now, I'm going to go a bit beyond what others do. I'm going to be giving you a downloadable Excel spreadsheet that I'm going to walk you through so you can play along with it and you can figure out exactly how it works. As ever though, it's going to be based around a silly story that simplifies everything down. Let's dive into it. We're going to base this silly story around a young man called Kalani who's down on his luck and he's in absolute poverty. He's got nothing. He has nowhere to live, no cash, but he is in luck. He receives a phone call somehow, I don't know how, from a lawyer, and the lawyer says, good news, you've got a very rich grandma that you didn't know about and she's died, not great news, but she's left you something in the will. Kalani is so excited, he says, come into the office and you're going to find out. So Kalani goes into the office super excited. Oh, I'm going to get loads of cash. I'm going to have loads of money. This is going to be fantastic. But not quite. The lawyer says that Granny has left Kalani Granny's gym. An asset of Granny's gym. Kalani says, okay, yeah, where's all the cash then? Where's all the money? I want the notes. I want the coins. He said, no, there aren't. You're not getting any cash. You are getting the gym. And the gym, great news, it's worth 1 million euros. He goes, yeah, but where's the cash? I want cash. I need cash. I want to pay for the shopping, for the food, for the bills. He says, well, no, there isn't cash. There is only this gym, an asset. He goes, but I don't want that. I want to be profitable. He says, you are profitable. Think about it. Before you had nothing. Now you have an asset worth 1 million. You can turn that asset into cash. You could try and sell it, although not many people are interested in my silly story, but you could turn it into cash by turning it into a business venture. Little Kalani sits down and he thinks about this and he says, okay, I'm going to work out how to turn Granny's gym, which is a bit old, into a modern day gym that will make some money and that I can have cash coming in. He sits and thinks about it and he says, okay, I'll need a new machine over here. I'll need a van with some marketing on the sign. I'm going to call it Kalani's gym. And all of this, like in my picture, what a fantastic gym it's going to be. He says, great. But in order to do that, he sits and makes a list. What will I need to happen? Here's my silly questions. He's got a couple of problems that I'm going to give to you now. These are some doubts he's got. He says, well, to make this work, I really could do with employing on a salary my friend Sarah. And Sarah's an excellent worker. I can get her on a contract. She's really strong. She can help move all the gym stuff and she'll be brilliant and encourage everyone to come to the gym. But Sarah is only going to give up her job if I can commit to giving her a 2,000 euro a month salary. Can I afford to do that? He thinks, at the moment, I don't have any cash at all. I've only got a gym. Can I afford to do that? He also thinks, well, can I commit to buying a friend's van? Now, silly story here, but he's got a friend, and this friend, for whatever reason, stupid, is going away in a year from now, and he's got a van that is worth, in my stupid story, 20,000. It's a great van. But he says to Kalani, I will give you the van, I will sell you the van before I go, but you have to sign an agreement now. I don't know why it's just my stupid story, but in a year from now, I will let you have the van for half price, 10,000, if you sign an agreement. But if you sign an agreement, you've got to give me 10,000. Kalani has to think, am I going to have 10,000 to buy the van? I really want the van, but have I got the money in a year from now? Thirdly, he needs to think, well, in all of this process, I don't actually have any cash. Do I need to take a bank loan to get some cash? I've got an asset, I'm profitable with the gym, but do I need a bank loan to get some cash straight away? And if so, how much? Now, you can think about that. How does he answer those questions? How does he know the answer to those things? Well, Kalani doesn't know. Maybe you can think of a way. But Kalani goes back to the accountant. For whatever reason, he's become good friends and a mentor, and the accountant is going to tell him how. He says, what you need to do, Kalani, you can't answer those questions without doing a cash flow forecast. A cash flow forecast is an estimate, a forecast, like a weather forecast. It's not going to be exact. It's looking into the future. It's looking at the next year, an estimate of the future cash inflows and outflows of a business, usually done on a monthly basis. This then shows the expected cash balance at the end of each month. Kalani says, that's great, but I've got no clue what you're talking about. Help me out. Can you explain how to create one? The accountant says, absolutely. So we're going to show you now how to create the cash flow forecast. The accountant, it's January 2025. He said, look, I'll help you draw up a cash flow forecast, but I'm going to need some information, and I need it to be as accurate as it can be, your best guess at these things. So Kalani has to sit down and think, and here come the questions. The first is, how much on January 2025, how much cash do you have in the gym bank account? So we can imagine that he's opened up a bank account for the gym. How much cash have you got in there? Literally money that you could take out at the cash machine. He sits and thinks, he goes, that's an easy one. 0. I've got absolutely nothing. Okay, the accountant makes a note of that. Next question, he says, what are your possible cash inflows each month? Kalani goes, what? I don't know what you mean. He said, well, think about it. In the gym, you're going to be spending money. We're going to call them outflows. It sucks, but you have to spend money. But you're also going to get money coming in. Hopefully, that's a business. What are all the inflows coming in? He said, so how are you going to make money? He said, okay, right, well, I'm going to have a membership fee. I'm going to charge people to be members to the gym. Accountant says, wonderful, that will be an inflow. But now I need you to tell me how much you're going to make from that each month. Kalani goes, how do I know? He goes, well, that's the problem with cash flow. It's going to have to be an estimate, but we need your best guess. It might not be perfect, but your best guess. Kalani goes, oh, I really don't know. Well, he sits and thinks and thinks and thinks, does some estimates, does some market research, and he comes up with a number, and he says, I'm going to have memberships, which are, I reckon I'm going to get, best guess, 2,000 every month from memberships. You can see on my screen already. He said, well, what other money is going to come in? He said, well, I could also possibly do personal classes. I could run them myself. And he said, again, you've got to give me then the accountant, how much will you make from that? And he said, well, I think I can make 2,000 every month from the personal classes. Great, the accountant logs it down. Now, the outflows, what are you going to have to spend cash on? What are you going to have to spend money on? Now, in reality, the gym would have lots of things to spend its money on, but in my silly story, we'll keep it fairly simple. And he says, okay, well, I want to buy, I looked at the old gym, Granny's gym, and I need a modern treadmill. But I'm going to buy that. I've seen one for 4,000, but I'm going to buy it in March. I don't need it straight away. So I'm going to have an outflow in March. I'm going to have to spend 4,000 euros on a treadmill. I also, every month, will have to pay the electricity. Electricity is a funny one when we talk about variable or fixed cost, but that's for another video, have a look at that. But we're going to say it's a fixed cost because he's contacted the electricity company and he says he wants to pay a set rate, a fixed rate every month, irrespective of whether he's in or not. Not always done that way, but in my silly example, we'll make it fixed. So the electricity, I'm going to pay 500 a month every month, and also water, done in the same way, I'm going to pay 500 every month. Accountants writing this down. And then secondly, of course, fourthly, of course, there's Sarah's salary. I'm going to pay Sarah 2,000 every month. Again, there's other things you could say, well, what about your salary, Kalani? We'll keep it out of this little example, but they are the outflows. Okay, right. The accountant then says, that's wonderful. We're now going to turn this into the form of a cash flow forecast, and you're going to be doing some maths along with me. So here's the spreadsheet that's created the rough form that we're going to fill in. Now, I've also put a link to this down at the bottom of the video, and it's interactive. You can download it and you can play with this so you can fully understand what's going on. It's got equations set in it so that you can adapt and play along so we fully understand. But we're going to go back to the story of the accountant explaining to Kalani how to do it. So we need our information over here. Then there's three struck 3 parts or 4 parts to a cash flow forecast. We've got the inflows that go up the top, all the money that's going to go into the business. We've got the outflows, all the money that goes out. Then we've got the net cash flow area and then the opening and closing balance. And this is predicting the year. So this January here is the January of 25, then February of 2025, going all the way to January of 2026. So it's going to predict all of this. Don't try and understand everything now. As we go through it, you're going to get to grips with what's going on. So just bit by bit, we'll do it. Okay, let's start adding some numbers and see what happened. Now, the first thing is we're going to add just this first inflow. We're going to put 2,000 in here, but I'm not going to press return yet, because when I press return, it will make changes to all of the spreadsheet. But let's try and predict what changes will happen. You can try this again as well. Think what will happen. So if we look at this section, the inflows, well, this yellow box says total cash inflow. Well, there is an equation, but it's pretty obvious, isn't it? Total means all of these things added together. If this is one of the inflows, this is another inflow, the total is going to be all of those things. So in mine, if I press return now, it's going to be 2,000 plus 0. There's another 0 there. That's going to take that to a 2,000 plus 0. It will be 2,000. Then we've got the outflow section. Well, I'm not putting any information in there. It's all 0, so that shouldn't change. Then we come to net cash flow. Now that's an interesting one. We'll have a go first time and then we'll keep coming back to it. You'll get used to it as we go more through and try more examples. But the net cash flow, think of it like a net with fish. If you had a net and 3 fish went into the net and 2 fish jumped out, what would be left in the net? Well, it would be the ones that jump in minus the ones that jump out. 3, 2 went out, there'd be 1 left in the net. Well, the same for this cash. If we've got 2,000 jumping into the net and 0 jumping out of the net, how much is left in the net? Well, that should go to 2,000 then. So the net cash flow, an equation, but it's inflows minus outflows. That should be 2,000 minus 0, that should go to 2,000. Now, this bit, I don't know why, but children always get confused about this. If you've got your own bank account, it should be the simplest thing. We're then going to say the inflow, the opening balance. This, forget what's going on in the table. We're now going to look at the actual bank account. If you went to the ATM, the cash machine, and looked at it and said, how much money do we have in the bank? This is on the 1st of January, the first minute of the 1st of January. The opening balance, well, that's going to stay as 0 because we can see how much do you have on the 1st of January? Nothing. Okay, but if you have nothing in your bank on the 1st of January and through the month you get 2,000 coming in but nothing going out, how much would you end the last day of January with? Well, you get in that net, you keep 2,000. Well, that 2,000 would then stay, the net is essentially your bank account, stays in your bank account, and therefore you'd end the month with 2,000. Okay, so I reckon, you should be guessing, I reckon this is going to stay as 0, but the closing balance should be 2,000. Now think about that. Is there anything else that's going to change? The answer is yes, because if 2,000 is the closing bank at the last minute of January, nothing happens with that until the first minute of February. So if you close January with 2,000 in your bank, you're going to open February with 2,000. So I think this is going to have an opening balance in February of 2,000. If it's not, someone's been robbing you and the bank's been taking your money. Where's it gone? Then, if we don't add anything else to this table, then we should have 2,000 opening in February. We're not going to have any money because I've not put anything in here. But if you open and no one spends any money in February, this should go to 2,000. If you have 2,000 to close February and nothing else changes, you should have 2,000 to March. So I think this whole thing should jump along. Here we go. Let's press return and see whether I've set this up correctly with the equations. Let's see. And there we go. We can see 2,000, total 2,000, no outflows, the net 2,000, and therefore 2,000. Try it yourself on your table. Now we've got to add in another inflow. So we said we've also got the personal classes. So we're going to put 2,000. This one should be a bit simpler. If I press return, what's going to happen? Well, I think you should be able to guess, try it yourself. 2,000 now. It's plus 2,000 because of the total, 2,000. This is going to go to 4,000. The outflows won't change, but therefore we're going to have net cash flow is 4,000 and all these should change. Let's just check. There we go. Have a go at it yourself. We're then going to go to the Outflows, the same premise. We're going to leave this March number to start with. We're going to go to the electricity and we're going to put 500. Okay, when I press 500, when I press return, what's going to happen? Well, we're going to have, the inflows aren't going to change, but we're going to have a total outflow now of 500. 500 plus all these zeros, it's going to change later, but that should go to 500. Now think about this net that captures. We're going to have 4,000 coming into the net, but we're going to have 500 coming out. That's going to leave us with 3,500. So that net cash flow should go to 3,500. That means we're going to adapt our closing balance. Sorry, he's not going to have a closing balance of 4,000. He's going to have 3,500, and that should run all the way along. And there we go. We now need to add Sarah's salary, so let's put 2,000 in there. And when we press return on 2,000, think about it. Well, the inflows are not going to change, but we're going to have 2,000 plus 500 here. It's going to change the total cash outflow because it's not just 500. We've got to plus that 2,000. That should go to 2,500. Then think of the net. If we've got 4,000 jumping in, 2,500 jumping out, what's that number going to change to? Let's have a look. And then it's going to change all the balance along. Now this is useful because we can see we're starting to predict if it was this simple, and of course no business is this simple, we could say, well, in January I'm going to have 1,500 a year from now in my bank, but this is ongoing is where it gets complex and we need this table. I'm going to quickly add in the other numbers. We're going to put 500 in. You should have a guess of what's going on there. And then we've got the van payment and the treadmill that's coming later on. Now, the reason Excels are excellent, and the reason we really use Excel, we never do it by hand, you have to do it in the exam, but in a real case, we do it with Excel, is because you don't have to do all the maths. You can just drag this along like I'm going to do. And this is going to put all of this information, taking it right through the year. We can extend it on for 10 years. Of course, the further into the future you go, the less accurate this is going to be, but we're now having it for a year. I can drag the bottom of this square and it's going to take that 2,000 because we're saying they are fixed, they are the same every month. In reality, we know a lot of these things wouldn't be fixed, they would vary about how much they would get for memberships every month. I'm going to do the same, drag it along here, each of these things, because we know they're the same. Dragging them through, you can do it. Now this is looking pretty useful. Now suddenly we could say, well, if this was the case, and it's not, remember, because he's still got to buy his treadmill and potentially the van, now we've got some really useful information because we're seeing, well, how much is he making in net cash flow per month? We can see in this situation, well, actually, he's making a net cash flow. He has, on average, in a prediction, 4,000 flowing in and 3,000 flowing out. That's making 1,000 each month. Therefore, by January of 2026, he should have a closing balance, a cash balance of 13,000, which is what Kalani has been looking for. Remember, he was like, I've got an asset, but I want cash. Well, he should have 13,000 in cash in his bank. Okay, but we've still got to add on those other variables. Remember, he wanted a treadmill. So we're going to put that treadmill in March, first of all. But let's see if that creates any problems. 4,000. Okay, we've got a problem, first of all. Can you see what it is? Have a little look at it. Well, when you add the 4,000, first of all, we've got March now. We're not going to have a net positive cash flow because March, 4,000 comes in, but 7,000 comes out. That's going to be minus 3,000. He overspends by 3,000. In the real cash flow forecast, really important, we put that with brackets. Excel doesn't put the brackets, it puts it as a minus. But you must, really important rule, put brackets. That signifies. The minus can be missed when you handwrite, a little small thing. We want to make it really clear because it's super important. On your own personal thing, you might want to turn it red and go, whoa, that's a problem. I'm minus there. Now, that not making a positive net cash flow maybe isn't such a problem, but there is a problem when it comes to a bank account, because if we have a look here, his opening balance was 2,000, but he closes with minus 1,000. Now his bank manager is not going to be happy with that. It's not going to be allowed to happen unless he's got something called an overdraft. Again, that's for another video. But that means something's going to have as a problem. He's going to have a liquidity problem. He's not going to have the ability to pay his short-term debts in March. Therefore, we can't get that minus 1,000 unless it's an overdraft. He's not going to be able to pay Sarah or his electricity, and that's going to get him in all sorts of problems, a liquidity crisis. So the good thing is of doing a cash flow forecast, though, he's knowing about this back in January. So he's sitting down with the accountant and he goes, well, hang on a minute, I can see I'm going to have a problem in January there, and I need to prepare for it now. Okay, he's flagged that, but we remember we've got another thing going on, that he wants to buy this van in January of 2026 for a cost of 10,000. So he goes over here, we're going to put the van of 10,000, I'm going to put the 10,000 in here, and how can he get on? Press return. Yes, he's got this problem again. We know that in January he's going to have a negative net cash flow, 4,000 coming in, but 13,000 coming out, making it minus 9,000. But again, it's going to take him down to that minus 1,000. So let's take this information, let's go back to the questions that we asked and see what are the answers to them. The first question we had is, can he employ his friend on a 2,000 a month salary? Well, using the estimate, and remember it's an estimate, it's not perfect, these are all guesses, it seems yes he can, because he's going to have a regular monthly income of 4,000 and the cash outflow, including Sarah's salary, would be 3,000. So yes, it seems that he can confidently pay Sarah. Can he commit to buying his friend's van? Well, no, not currently, because it would leave him in these negative numbers that we see over here. But they're not so far out. So this third question is the important one. Should he borrow money from a bank? Well, bank loans, they charge interest. So you don't want to get more than you need. You want to get the right amount. And this table is going to be really useful to know exactly how much he needs to borrow. Now, the bank loan is not the only solution. We're going to do another video on how we can use this cash flow for the other sources of finance, deferring payment, overdrafts that we mentioned. That's for another video. But let's just say the bank loan one. Well, we're going to put this as another inflow in January. How much money do you think he should put? Well, the great thing of a cash flow forecast like this, you can just play around. Let's see if he puts 1,000, he asks the bank for 1,000, which isn't very much for a bank loan, that would be high interest. But let's put it in 1,000. Does that solve his money situation? Well, yes, we don't now have any negative closing balances. This goes down to 0, but no negative numbers. However, you then think, would I be comfortable with that? These are only predictions, they're not accurate. I don't think that gives me much of a comfort blanket, because in March, I'm going to be running a business that at the end of March, at the start of April, is literally not going to have any cash to spend on any emergencies. Cash is important. We need it when the drinks machine breaks and I have to pay the person to repair that. At that point, I'd say, I can't repair it, and the customers would be unhappy. So 1,000 doesn't sound sensible. Why not give yourself a bit of a cushion? It's a bit of a pain, but I'm going to borrow 5,000. Okay, we can borrow 5,000. We press that, but let's not forget, that's now great. We're staying in positive cash, but when you borrow money for a bank, it's not free. You're going to have monthly repayments. So we're going to add those monthly repayments to the outflows now. They're going to be regular. Now, it depends on the interest. It depends on how long you take it, but you can drag it out. But let's just say he's borrowed the 5,000 and he's got to pay, the bank has said, 100 over how many months? I haven't done the maths. But let's say it's 100. He wouldn't pay it back in January, he'd take the money, but we're going to have to put 100 for however many months it would last. Will this create problems? Let's put 100 in there. I'm going to drag this over. And there we go. We can see that that doesn't create too many problems. I don't know how many months we'd have to drag. From this, we're now in a superb position. It's an estimate, I've stressed that he could say, well, I don't have any cash, but I am profitable. I've got this asset, thanks to grandma. And I know that a year from now, I'm going to have a business which is going to have a van, and it's going to end January with 2,800 in cash in the bank. That's all it for cash flow forecast. Play around. I really believe it's not just about remembering equations, it's playing with it, understanding it, using it. We're going to do another video later on all the different sources of finance and how it affects it. That's it. Hope it helps. Don't forget to like and follow. Any questions, write them in the comments. So in this video, we're looking at income statements. They're also called profit and loss statements, and that's one of the confusing things about all of this stuff. It's got lots of different names used by different people in different syllabuses, but we're going to be breaking it down so you can fully understand what's going on and therefore not get put off by the terms. We're going to cover the main features of an income statement: revenue, cost of sales, gross profit. We're going to look at some quick calculations, and we're going to show what they're used for and why they're so important and why every business has to do one. As ever, I'm going to turn it into a silly story. This silly story, we're going to have Big Al. He's very boastful. He's up at a party and he's talking loudly saying, yeah, last year in 2024, I made a revenue of €1 million. Now that sounds impressive. The people at the party should be impressed by that perhaps, but we've got a cynical group. I've put some funny characters in here. I've put Mr. Government, Miss Investor, Mr. 2023, Mr. Lender, Mr. Competitor in there. And they're all not quite so easily fooled by this talk of a revenue of $1 million. They've got other interests and they want to dig down into the numbers. They've seen that this guy has got cash. He seems to have loads of cash, money, coins coming out of his pocket, and he's buying drinks. But these people are saying, well, we know that cash and successful aren't always the same thing. Perhaps he borrowed that cash from a bank and it's not really his. We want to dig in and find out what profit did he make? Is he running the company well? So if he's talking about last year, 2024, they want to find out exactly what profit he made in 2024. And in order to do that, they're going to have to look at the profit and loss statement or the income statement. So these statements look different wherever you look at them. We've got some complicated looking ones on the screen, but I'm going to be breaking it down in just its simplest form. What are they all about showing? So here we have my version of the income statement for Smooth Al Ltd. Now at the top of the income statement, we're always going to have that thing he was boasting about. We're going to have revenue. Now revenue, an equation, but it's common sense. Revenue is how much do you sell the things for times how many did you sell. So if he sold Porsches, he didn't make the Porsches, but he sold Porsches, and he sold each one for 100,000 and he sold 10 of them, the revenue would be 100,000 times 10, and that would give him a revenue of 1 million. Now, while that's great, when I'm teaching income statements to my children, I always talk to them about story of misery, because they, yes, get the money coming in from the revenue, but businesses also, of course, have to spend money. So revenue is definitely not the same as profit. And we even have different types of profit. So we have to be very exact in our terminology. Now, the first profit we're going to talk about is gross profit, or in a terrible French accent, gross profit. The reason I say that is because gross in French means big or fat, and that is the biggest profit that you keep. So while he had a revenue of $1 million, we also have to look at the cost of sales, because he didn't make Porsches. He's not Porsche the company. He bought them from the Porsche garage from somewhere else, and he had to pay money for that. So if I said he bought each Porsche for 99,000 and he bought 10 of them, well, he had to spend himself on buying the cars in order to sell them. He had to send to Porsche 10 times 99,000, which is 990,000. So he can gloat all he likes about a revenue of $1 million, but he didn't get to keep $1 million, because in order to do that, he had to spend 990,000. We call that gross profit. So gross profit, you can see the equation, it's revenue minus the cost of sales. So in actual fact, his gross profit here is now only 10,000 euros. But this is a story of misery, and it gets even worse. Because yes, businesses have direct costs that they have to buy the car, but they've also got all sorts of indirect costs that we're going to call expenses. This can get a bit tricky in the exams, but again, a common sense understanding. These are all the little things that you have to spend that you forget about oftentimes. So in this situation, although he seems to buy a car, sell a car, actually he has to do things like, well, pay the rent for the building. He has to have the lights on in the building and pay for electricity. He has to pay for his lunch. He has to pay for his workers a salary or a wage. All of those we're going to call expenses. And that money doesn't come from nowhere. He has to pay that as well. So he also, in this story of misery, has to write down his expenses. We're going to say here that he has expenses, quite cheap, of 9,000. That's 9,000 that he spends on rent and on wages and whatever. So when we're looking about how much does he keep, oh, I had a revenue of $1 million, he said. Yes, but you had to spend 990,000 on the cars, and then you had to spend 9,000 on your expenses, so you didn't get to keep $1 million at all. In actual fact, while your gross profit was 10,000, your profit was only 1,000. Now we pause here because this is where it gets across all the different syllabuses tricky. I wish they just called it profit. In my syllabus currently, Cambridge, they're calling it in profit. In other syllabuses, they call it net profit, essentially means the same thing. In others, they call it operating profit, but it's all the same sort of thing. It's the profit, which is gross profit minus expenses. And in this point now, he's only got 1,000. But he doesn't even keep that because he's a business and he's a limited company. Of course, businesses need to pay tax to the government. They have to pay corporation tax. And corporation tax is set by the government, but if we work on the basis of it being about 20%, that we can calculate. Well, we would calculate that off the profit here. What is 20% of the profit? He has 1,000. 20%, you can use your maths. 20 divided by 100 times 1,000. Therefore, he's going to have to send off to the government, pay the government 200 euros. That leaves him, therefore, not with $1 million. You can boast about it, but in 2024, you didn't get to keep $1 million. You, in actual fact, you had a profit of 1,000, but you had to give 200 of that to the government. That left you with a retained profit of just 800 euros. Not quite as impressive as we first thought. So let's go back to this party. Who are the people at the party and why were they so interested in these numbers in my silly story? Well, if we go through, the government is going to be very interested in his income statement because the government has to trust that he is paying the right amount of tax. So they want to have a look at these numbers because he said, oh, by the way, I owe you 20% of this 1,000. They want to be able to check. Okay, yeah, that looks right. Yes, that is 20%. Therefore, you do just owe us 200. If we don't see this, he can just make, well, I didn't make any money, I don't owe you any tax. No, they want to see all of this recorded data. So government, as a stakeholder, are incredibly interested in the income statements. We've also got Miss Investor. Well, if she thinks this guy's impressive, I want to invest, I want to put money in to make more money, she's seen he's got lots of cash, but does that cash mean anything? Is he running it well? Well, revenue sounded nice, but when she dug down into these numbers, he wasn't running it too well. He only had this retained profit of 800 euros for the whole year. So she said, well, I thought it was good. I've looked into it. You're not that good. Next, a lender. Well, the same reason. If he wants to go to a bank and say, I want to borrow 500,000, I had a revenue last year of $1 million, the bank, the lender would say, well, who cares? The revenue's nice. Okay, you sold, but how much was it costing you? And they'd want to break these numbers down and look at it very closely. How much are you spending on your expenses? All of these things. And they'd make the decision off this as to whether to lend. Mr. 2023, I've called it, a silly one there. But if you were the boss the previous year of this company, you weren't Al, then he's going around boasting. You'd want to look and compare. Similarly, if there was a manager above them, in order to work out whether Al was doing a good job, you couldn't just look at how much cash he had in the bank. That would be irrelevant. He might have just borrowed it all. You'd want to look at the income statements comparatively. If the year before they had a revenue of $1 million, but they had a retained profit of $500,000, well, the previous boss would have been doing better than Al. So we'd compare it year on year. To the same extent, this is done very exactly at the end of a period, but we can also forecast it and look into the future. Lots of businesses would do a forecasted, projected income statement. But we wouldn't expect that to be perfectly accurate. That would be a guess, but lenders and people would want to see it. Finally, a competitor, of course, would be interested. And if you're a limited company, then you're able to look up your competitors, because that's one of the negatives of being a limited or a public limited company, is that you have to share your financial documents. So they would dig down, they could look it up on the internet, and they'd be really interested to see how much you're spending. Maybe you're struggling and we can do a good advertising campaign to kill you off. So that's it. That's income statements or profit and loss statements in a nutshell. If you've got any questions, as ever, write them in the comments. And a like and a share really helps. Any questions, just ask. In this video, I'm dealing with a finance topic that scares a lot of children. Statements of financial position, also called balance sheets. Now, on my screen, you can see one, and it's pretty easy to see why it scares a lot of children. Even that one that's from an IGCSE textbook looks scary, and they vary across different syllabuses and at A-level, so it confuses people. That's why in this video, I'm going to be breaking down exactly what they're all about, the idea behind them and why they're so important. I'm going to show you how you can make some simple calculations, and most importantly, how you use them to make decisions. I'm going to do it in the form, as ever, of a silly story, and in this one, a silly and marginally offensive game that I want you to play along with me. As ever, if you don't understand anything, just write it in the comments, give the video a like and a follow, and you'll find loads more content on the channel. As promised, here is our ridiculous game that we're going to play. Now, it's going to seem totally weird, I know that, but that will stick in your head. And bear with me, I'll wrap it all round into the full business at the end of it, where you should fully understand it. So stick with it. Now, the game we're going to play is you are going to be a gold digger. I'm going to get all the names wrong and all of those things and genders and whatever, but just stick with it, just pretend and play along. And when I ask a question, I recommend that you pause the video, think about it, even write it down, because it's going to be good to reflect on your answers, because I might well have tricked you in the video. Let's see how we go. So, in my story, you are going to be a gold digger. A gold digger is someone who is marrying for money, a horrible thing. And you're even worse than that. You're someone who's currently dating 3 people, but you're deciding which one of those to marry. Now, you're dating Annabelle, age 20, Betty, age 20, and Carla, age 20. They are all the same in terms of personality. You can't split the difference. In terms of how they look, you can't split the difference. You're going to make it purely on a decision based purely on who is the richest. You are a horrible person, I'm well aware of that, but we're going to play along. Now, it gets worse because you've been sneaking and following behind them, and you've followed them to an ATM, a cash machine, and you've spied on them with binoculars to look over and see what is their available cash. You say, I know, to find out who's the wealthiest, I'm going to see how much cash they've got in their bank. We've got Annabelle, you look over her shoulder, she's got 100 euros. We've got Betty, who's got 50,000 euros, and we've got Carla, who's got 1 million euros. Now, question number 1, pause the video and write it down. In that case then, simple, easy, which one are you going to marry? Now, I imagine you've made your decision. If you're anything like the children in my class, you're going to come back and say, well, this is so easy. It's Carla, obviously. Why? And I say, well, yeah, I know that, but why? Let's put some words. And they say, well, Carla, because she's rich, she's wealthy. And I say, but what about Annabelle? And they go, no, Annabelle's so poor. I don't want to be with Annabelle. Annabelle doesn't have any wealth. Okay, we're now on to round 2, where you do a little bit more snooping. So in round 2, we have the same situation, but you find out a little bit more information. Perhaps at this point, if we play along in my class, you've been and seen Annabelle and Betty and said, goodbye, I don't want to date you anymore, and you're firmly on track to marry Carla. Okay, but here's some more information. Does this change your mind? Can you change your mind? Can you go back and speak to the others and say, I was wrong? Here we go. Annabelle owns 3 large houses. We've got Betty, who owns 1 small house, and we've got Carla, who lives with her parents. Again, next question, stop, pause the video, have a little think. Does this change your mind? Now, at this point, I don't know what you've decided. Some of you are going to say yes, some of you are going to say no, but you've got a decision. But are you still describing Annabelle as poor, like you probably did in the previous one? We've started to think that, hang on a minute, maybe wealth shouldn't just be judged on the amount of cash in the bank. We also had to look at what property they had. Okay, well, you make your decision. We're going to go to round 3 though. I'm now going to give you a little bit more information. So same deal, but here's some extra information. Annabelle owns a student loans company, €4,000, but no time limit. She can pay at any point over the course of her life. We've got Betty, who owes the bank €50,000 for a loan she took out recently, and she's got to pay it in 1 year. She owes €50,000. We've then got Carla. Carla has $500,000 in credit card debt. Has to be paid pretty soon, a credit card, or bit installments have to be paid. She's got a bank loan of €800,000 that has to be paid in 1 year, and she's got car repayments of €250,000. Okay, pause the video now and have a think. Who do you want to marry? Now again, I don't know who you've chosen here, but what I hope I've done is trapped you with some of the statements earlier on. When we were looking at wealth, you described Annabelle as poor and Carla as very rich, as loaded and jumped. But I think you're probably now seeing, well, Carla isn't very rich at all. In fact, they've got some serious money problems. They may have 1 million in cash, but they have debts that they need to pay soon that add up to way more than 1 million. So essentially, they've got less than zero. They've got real money problems. Then you've got a decision between this Betty and Annabelle, but it doesn't seem that we could call Annabelle poor because, okay, she only had €100 in cash, but if she's got these 3 large houses, and let's say each house was worth 2 million, we could just sell one of the houses, get 2 million in cash. She doesn't seem to be poor, and that bank loan doesn't really seem to be a problem. So when we're looking at wealth of people and of businesses, you shouldn't just be thinking about cash they've got. That's a classic mistake. You need to consider other things. But the game is not quite over. We've got one more round. Make your decision. I hope you've already made it who you're going to marry. Now, here we go. The final round. Now we've got Annabelle. She's got all the things before, but she bought the 3 houses with money she made from drug dealing. Told you it's a silly story. Okay. We've got Betty, who's 20, remember, and she bought the house by working hard and saving money since the age of 16. And we've got Carla, she's never worked and the money was given by her parents. Right, I'm hoping at this point, this firmly changes your opinion on the story. I don't know who you're going to choose, but I would suggest now in all of this, I've tricked you, and I'm hoping the most sensible option would probably be Betty. Some of you, if you're like the children in my class, go, nah, I'm still going to go with Annabelle. She's got all of those houses from drug dealing. But that is what we would say low quality money that could be taken off by the police. It's illegally gained and could be taken. Could risk it, but it doesn't sound like a good investment there to go with this person. That money could be gone. We've got Carla, terrible. She had cash, but it's come from, yes, being given the money, low quality. And we've got Betty, who's made this money herself. She's only 20, and since the age of 16, she's managed to save up enough money to buy a house. Whatever she's doing, she must be very good at it. And she can buy herself a house at the ages of 16 to 20, my goodness, she's going to go on and make a lot of money in business or selling or working in the future is the idea. And I would suggest that in this gold digging story, Betty is your best person to get married to. What a terrible, unethical story. Now though, let's tie it back to how it relates to business and statements of financial position. So a statement of financial position shows the value of a business's assets and liabilities at a particular point in time. Now that's what we've just done in that story. We were looking at a person's wealth, but these statements of financial position show the wealth of a business at a particular point in time. Cash flow forecasts and profit and loss statements don't cover those things. Cash flow forecast how much cash they'll have in their future, not wealth, but cash. And profit and loss just show the profit that was made over a period of time, over the last year or the last month. They don't talk about how much wealth. You want to know wealth, you've got to look at a statement of financial position because you need to know all of these terms. You need to know these things. You need to know non-current assets that the business has, the current assets the business has, the current liabilities, the non-current liabilities, and you also want to think about where all of that money has come from. Now, they sound complicated terms, but let's just break it down. An asset is a good thing. If I said you're an asset to the classroom, that would mean you're a good thing into having a classroom. But if I said you're a liability, well, a liability would be a bad thing. So we've got assets, good things that people have. So non-current means that you've got it for a long period of time, something that will take a long time to change into cash. So buildings and houses are non-current. They're good things to have, but you've got them, you expect them to last longer than a year. So a building or a house. Then you've got current assets like cash, well, that you can use quickly. Cash is certainly good. Then you've got current liabilities, liabilities bad, and they're debts. That means debts that have to be paid in under 1 year. And then you've got other debts that maybe aren't so urgent, debts that can be paid over a year, maybe over the next 10 or 15 years. Then we think about where they are. So to know all of those things, we need to look on this complicated document, this statement of financial position. So if you were interested in investing in a company, or you're a government looking at the wealth of the company, you need to look at this document because you'd want to know all of the answers to those things if you're the owner of the company. So you can see they take different forms across different exam boards, across different accountants, but they should all contain this information. In this one from the IGCSE, we can see it's broken down into 2018 and 2017. So if we just ignore 2018, we'll just look at this column 2017 here. We can see, hang on, we need to know the non-current assets. Just like in that story, how many houses did Annabelle have? Well, we're going to look for this section. Non-current. It could be down here, it could be hidden anywhere, but there will be a section for non-current assets. Then we've got current assets over in this section. Then we've got the liabilities, usually go below, and we will go and look into breaking those liabilities, those debts down into current liabilities and non-current liabilities hiding here. And then finally at the bottom, this is the part, bit complicated, that shows us, well, where did they get that money from? So if we look at Annabelle to compare it to these things, because we could put her into this table, it's more simple than the one here, but Annabelle, a bank balance, well, where would that go? Bank balance cash is current, and therefore we would drop it into this section. If you were to draw one up for her, it would come into this section. We then said, well, we also know she owns 3 large houses. That would be dropped into this section as a non-current asset. Then, she owes a student loan, but important, no time limit, so that would go into the non-current liability. Then, has she got any more liabilities in red? Well, no. So she actually didn't have any current liabilities. That's pretty good. She's got none. And then she bought it with money from drugs down here. Okay, so all of that information, if you were to draw up a statement of financial position for Annabelle, you would add it in those cases. If we look at this, though, in a bit more detail, then they used to be called balance sheets, still are in many places, in fact, because governments are particularly interested, could be other people, but they're particularly interested in saying, okay, well, this essentially is your wealth, that you're saying in 2017 you had a wealth of, and I'm using that term very inexactly like I did previously, of 820,000. Okay, 820,000 here because we had the assets adding up to 1,011 here, this number here. And then we had liabilities to take away because you didn't have those, but you had a sort of net amount. And again, different terms with different syllabuses, but we're going to just say wealth of 820, okay. But then it's legitimate to ask the question, well, if you're saying that at this point in time, when they did it in 2017, at that point in time, you're worth 820,000, your wealth is, where did that come from? Can't just come from magic, you must have got it from somewhere. So if we look at this, this is where we call it the shareholder's equity or shareholder funds. This one's quite interesting here. They said, well, the money came. Yes, we did have 820, and this is where it came from. We had 500,000 came from share capital. That means shareholders invested that money. They just gave that money to the business, and 320,000 came from retained profit reserves from previous years that we'd made. So 500 plus 320, that adds up to 820. Great, you can balance it then. It therefore justifies all the amount of money. So the governments are happy. Yes, we can see that you're running this legitimately. Those two things balance. But when I was talking about drug dealers before, because if you're assessing the business, you're also going to say, well, you know what? Yeah, you might have money, but is it good quality profit? Is it good quality money? In this situation, what do you think? 500 they were just given by shareholders, and only 320, less than half, came from actually earning it, from doing the job, as it were. Do you like that? Well, there's no right answer. Some people might say, well, yeah, it's good because it shows people are confident and it's going to get better. We like that idea. 500,000 has been invested by people with confidence. Or you might say, but no, that's not really making money. Only 320 is made by doing the job, and therefore we're not confident in it. Okay, so that's statements of financial position covered. As I said, they vary everywhere, but what you should have got from this video is an understanding of what to look for and how they work. You can then take that back to the key terms and the new definitions as they change, and don't be scared of them. If you're looking at an IGCSE exam, they're going to be so much simpler. Although the books put these exams, if you look at past paper questions, which we'll do in another video, they are so much simpler. I hope it helps. Write in the comments any doubts that you've got, if you want any other videos, and see you soon. Welcome to Biz Ed Made Simple. In this video, we're looking at profitability ratios, and particularly gross profit margin and profit margin, which is also called operating profit margin in some syllabuses. Now, you can see the equations on the board, and lots of people think that that's all there is to know. And there's some truth in that. Lots of the time, it is just a calculation that you need to do. But you're going to miss a lot of marks when they ask you to analyze the accounts, because you really need to understand what they're for and why they're useful. And lots of people don't realize that. They just think it's annoying. Oh, I hate ratios, I hate maths. But they're actually essential in business in simplifying things. So I'm going to, as ever, explain it with a silly story. Now, for my silly story, we've got investors, Dragon's Den style, or Shark Tank if you haven't seen it. And they're looking for an investment, but they are going to make their decision purely based around profitability. They're not going to look at the product. We're not going to discuss that. They just want ones with looking like it would be very, very profitable. So they've got two potential investors that they're going to compare. They've got Antonio and Lisa, and they just want to cut to the chase. And they just say, tell me about your profitability. Now, Antonio comes up with this very confusing answer. He says, in 2024, I had a revenue of 1,267,498 Mexican pesos and a gross profit of 987,674 pesos. And they look confused. They go, what? Hang on, what currency is this? Why are we in Mexican pesos? They turn to Lisa. Lisa says, well, in 2024, I had a revenue of $867,528 and a gross profit of $327,664. And they're lost. They're going, hang on a minute. I wanted this to be simple. I'm now really confused by all these numbers and difference of currencies. Don't you understand about profit margins? And they say, no, they don't. So they're sent back to school and we go on. So to understand this, you really have to go back and watch the video on income statements. If you haven't seen it, the link's up here, and this will be breaking it down, because this is essential to understanding profit margins, is understanding all about profit, which is explained in that video. So Antonio goes back to his teacher, whoever it is, and explaining about numbers. And we say, well, look, okay, yes, you went and told him these numbers, but these are pretty long, confusing. We need to make it simple for him. So he said, well, I got my revenue of 1,267,498, and just like in the income statement story, he's proud of that. And they said, but yeah, that's lovely, but that's not what you keep. That's what all of the money that comes in. You've also got a cost of sales. You had to spend money on buying whatever you bought. And in this case, he spent 279,824. Again, complicated numbers. So that money went out, which meant as gross profit, you only kept 987,674. But all of those numbers are still too confusing. We want to simplify that down without having to talk about currency as a proportion. So he goes and puts it into this equation, gross profit divided by revenue times 100. If you put one over the other, you calculate it, check that I've done it right, that comes out as 78 Now, what does that 78% mean? That means that forget the currency, it now doesn't matter. Whatever currency he spends, whatever revenue comes in, he keeps, I'm going to come back to that, 78% of it. So if he has 100 pesos coming in, he keeps 78 pesos. If he has 100 million yen coming in, he keeps 78 million yen. It's as a proportion, and therefore that makes things much simpler. You don't have to worry about currencies. You don't have to worry about 1, 2, 6, 7, 4, 9 and all of those things. 78% is nice and manageable. You can round it up or round it down to be comparative. Okay, then we've got Lisa. She comes back and has to do the same thing. Now it's much easier to compare these two things. So Lisa does the calculation as well. You can put it through. She has all of the money coming in, 867, but then she spends on costs of sale 57, which means if she has $100 coming in, she actually only gets to keep $38 of that. Or 100 yen coming in, she only gets to keep 38 yen. So this now makes things much simpler. We can go back and you can think, well, who would you rather invest in? Well, it's much easier now. No complicated long numbers. One says, I got gross profit margin of 78. They don't have to ask twice as simple, 78. And the other one says 38. Well, this person says, well, that's fantastic. I'll go with Antonio because of $100 coming in. He will keep 78% of that. That's a great amount that he keeps. But the story's not quite there yet because this investor over here knows it's not quite as simple as that. So he asks the question. He says, okay, that's your gross profit margin, but what about your operating profit margin or your profit margin? He's asking because he's not happy about that word keeps that I've been using. He's saying kind of, but let's just check it out. Okay, so here's the point. He says, Antonio says, I got a gross profit margin of 78%. I think I had a profit margin of 92%. Let's just pause there and have a little think about that because they all go, ridiculous, get out. We'll come back to why in a moment, but there's no way that can happen. So he's sent back to school again to find out what is the question they were really asking him. He goes back to his table. Okay, Antonio, you had your revenue of 1.2 million or whatever, but you had your cost of sales. You had your gross profit of 98764. But you didn't actually get to keep that. It's a story of misery because you also had to spend on expenses, light, workers, electricity, those sorts of things. So you didn't keep that. Now let's go back to you, Antonio. How much did you spend in that year on expenses? And he says 900,000. Well, hang on a minute then. This is not looking quite so good. So if you had a total revenue of 1267498, but you had to spend 279824 on cost of sales and 900 on expenses, your actual profit, have a look at the income statement, your actual profit or operating profit was only 87674. That doesn't sound like a lot now. But again, 8764, that's a long, complicated number. They're going to want it as a proportion, as a percentage. So he puts it into the calculation, puts it into the equation, and he says, well, my profit margin is actually 7%. What does that mean then? Well, if he now gets 100 euros, 100 yen coming in, he actually gets to keep, never mind what he kept as gross profit, he really gets to keep 7%. Now, can we see why they laughed? They laughed because there is absolutely no way if Antonio had 1.2 and his cost of sales was this, and then profit is just taking the expenses off, there is no way that you can have an operating profit that was higher than your gross profit, because the only difference between gross profit margin and operating or profit margin is that you have to minus the expenses. The best set case scenario, an unlikely scenario, is you have zero expenses. But with zero expenses, your gross profit margin would be exactly the same as your profit margin. As it is, it's going to have to be lower. So they knew straight away, you've misunderstood, and that's ridiculous. Okay, well, Antonio then, now you're seeing, is not looking like such a good deal because he only actually keeps 7% from all of his revenue coming in. So they go back and look at Lisa again. Is she any better? We look at Lisa's numbers and, well, it's quite a different story. Okay, her gross profit margin wasn't very good. She had a revenue, it went out, gross profit was 32764, but her expenses were much lower, only 27,664. That left her from the 867,258, that left her with a profit of 300,000. As a proportion of that now, she kept 35%. So we can go back in front of the investors and we can say Antonio has a profit margin. What did he actually keep from his revenue? 7%. And in fact, Lisa therefore is the higher number, 35% she actually keeps. In all of this, I guess the question is, well, why do people talk about gross profit margin? Well, it's still not, it seems like it's irrelevant. You should always go with Lisa in this. But in reality, expenses are very difficult to calculate and inexact. So people, businesses and investors still want to know your gross profit margin. On top of that, when we're looking at the expenses, perhaps these investors are thinking, yeah, okay, I don't really care about expenses because I can use my factory or I can make you more efficient. So investors will still start by saying, give me your gross profit margin, then give me your profit margin. That's it for the video. If you've got any questions, write them below and I'm happy to help. And I would say the best thing to reinforce all this understanding, go and watch Dragon's Den. It's amazing the amount of people pitching get their gross profit and their profit margin mixed up. If you can sit and watch it and understand it, you'll be one step ahead for your exams. Welcome to Biz Ed Made Simple. In this video, we're looking at profitability ratios, specifically return on capital employed. Now, the equation is on the screen there, you can see it. But lots of people think that's all there is to it and they just calculate it. Now, the calculation is quite simple, but it's far more important that you get the analysis marks of accounts and you really understand what this number means. Most people don't. So in this video, I'm going to be breaking it down. I'm showing you it's actually a pretty simple thing, and I'm going to show you why businesses are so eager to calculate it. As ever, I'm going to do it with a silly story, so let's get into it. Now, the silly story this time involves me, Jack, and my imaginary brother, Tim. Now, if we say Jack in 2024 had a profit of 10,000 euros and Tim had a profit in 2024 of 30,000 euros, I've got the question at the top, who is performing better? Now, you're probably saying, what an easy question. Jack is a loser. Jack's rubbish. He's only got 10,000. Tim is smashing him here. He's got 300,000 in 1 year. That's loads more than Jack is making. However, I don't want to lose this fight if I'm fighting against my brother. I'm going to say, actually, Tim is having a disastrous year, or has had a disastrous year, and Jack has done really well. Now, pause for a moment and think, how can that be the case? Doesn't look like it. No tricks of numbers, no tricks of euros, but Jack has done really well and Tim has done really badly. I'm then going to say that I'll be able to explain why, and you hopefully will believe me. You'll say, oh yeah, you're right, without anything technical, without any calculations. Even if you've got no understanding of business studies, I'm going to put a little sentence up there and you're going to say, oh yeah, Tim really has had a bad year and Jack's done really well. Pause the video now if you want to think about that and try and work out what I'm going to do. But I'm moving on. So let's go into it. Here's the sentence. So Jack, me, runs ECM Tutors, the website, and does a little bit of YouTubing. Tim, on the other hand, runs Nike International. Now, if we look at those numbers again, hopefully I've convinced you. You're saying, well, hang on a minute. If Jack runs this tiny little website that probably hasn't put much money into it, and he's making 10,000 in 1 year, he's doing pretty well. I'd love to be making 10,000 profit from the ECM Tutors website. Whereas Tim, if you're running Nike International with all the money that's ever been put into Nike, and that's a lot, and you're only getting back 300,000 in a whole year, in the whole year of 2024 as profit, well, you're not doing very well at all, I would say. That's pretty poor for all the money that's gone into it. Okay, that's the background, but that is return on capital employed. We just need to get technical with it and put the terms. So let's have a look. So if we look at Jack and the calculation here, we're going to say that capital employed is roughly all the money that's ever been put into the business over its life. So Jack has put, in my example, 20,000 euros over however many years, maybe 10 years or whatever, but he's put 20,000 euros into ECM Tutors. Now in 2024, he got a profit of 10,000. If we put that into the calculation, 10,000 divided by 20,000 times 100, then he's got a return on capital employed of 50%. What does that mean? Well, it's pretty good. It means for all the money you've ever put into the company, you get 50% of that money returned to you, return on capital employed, returned to you in just 1 year. That's pretty excellent. If we look at Tim, on the other hand, in this, we're saying, Tim, I don't know what Nike really has, but let's say Nike has had 10 billion put into it as capital employed for all the years it's been open. They've had 10 billion euros put into the company, and he only got back in 2024 300,000. That's a pretty pathetic return. 10 billion put in, and with all 10 billion, all you've managed to return to yourself as profit is 300,000. If we put that in the calculation, 300,000 divided by 10 billion, he's got a return of 0.03%. Pretty pathetic. So if we have a look at these two things now, Jack has a return of 50%, Tim has a return of 0.03%. Jack clearly has performed better as a manager. However, it isn't just about performing as a manager. We look at actual companies. So you could say ECM Tutors has had a return of 50%, or Nike has had a return of 0.03%. But you could do it for a manager as well. Now, you're probably thinking at this point, but what is a good number of the return on capital employed? Well, like all of these ratios, there isn't always a set thing. It depends. You probably want to compare it to previous years or companies in the same industry. So if we look at this, we're saying, how much trouble is Tim in? How badly is Nike doing? Well, they'd want to compare it to other things. So the first person they might compare it to is, went the wrong way, is Jim. If we said Jim was the manager of Nike in 2023, well, if we look at that, and he had a return on capital employed of 0.01%, well, Tim's not done quite so badly then, because clearly something's going on at Nike. You could say, well, at least it's heading in the right direction. It's gone up since 2023. However, if I then add more information and say, well, Sue works and runs Adidas, or just Adidas the company, in 2024, we'd say, well, if Tim got 2024 in 0.03, what did Adidas get? And if we look, and Adidas had a return on capital employed of 20%, then I think Tim's got some questions to answer again. Why is Adidas doing so well, getting its 20% of all the money it's ever invested back in 2024, when you only got us 0.03%? So, return on capital employed is something really useful when comparing profitabilities. It's just too simple to look at, say, you got 10,000 in a year. We need to compare it against all the money that's ever been invested in it. That's it. Hopefully you fully understand it. If you've got any questions, write them below and I'm happy to help. And a like and a comment is really appreciated. That helps me out as well. Hope it helps. See you on the next video. Welcome to BizEd Made Simple. In this video, we're looking at liquidity ratios. Now, lots of people, you don't really need a video to read a definition and to know the two equations, current ratio and acid test ratio. They're not too difficult to use. However, where lots of people go wrong is they don't really understand what they're doing or why they're doing it, and therefore don't know how to interpret the result. In this video, I'm going to be breaking it down so that you can fully understand the results, know why we're doing it and why it's so important, and then you can get maximum marks, and you may even need to use it in real life. So I'm going to start with Nothing to do with business to start with. I'm just going to talk about a story of James, a boy at school, in my silly story. Now, we're going to work out how James is in terms of his liquidity. We can see from the definition that liquidity is how able James is to pay his imminent debts or current debts. So we've got to work out what he's got in terms of current assets. How much has he got? In simple terms, how much money has he got, but not quite, to pay off any debts that are coming up in under 1 year. I'm going to shorten it and say over the next couple of weeks, and I'm going to give him a debt. I'm going to say that James has taken out a short-term debt. He's borrowed some money from Big Bill, the thug of the school, and we're going to work out how risky is it and how able is he to pay back Big Bill. Is he going to get an arm broken because of this threatening person he owes money to? So, very silly. Let's get into it then. In order to work out James's liquidity and current ratio, we first need to know what current assets he's got. Now, current assets can come from lots of places, but in its simplest form, we can look at cash, money he's got. We can look at his inventory. Has he got any stock or anything that he can sell quickly, he can liquidate and turn into cash? And has he got any trade receivables? But we won't worry about that in this video. They're for another video you can see. So I'm going to give him some cash and some inventory. I'm going to give him 10 euros. And I'm also going to give him a chocolate bar. And that chocolate bar, he reckons he can always liquidate. He can always sell it at school very quickly and turn it into 2 euros. That would give him current assets, 10 plus 2, of 12 euros. Now, what about this debt? He went to Big Bill and he borrowed 6 euros. And Bill is coming back imminently later on that day to ask for 6 euros. So he has a current liability of 6 euros. Current liabilities, it says up here, can come from overdraft, trade payables, but I just focused on short-term loan. He took a short-term loan out from Big Bill. So, okay, current assets of 12, current liabilities of 6, but what does that mean and how do we use these horrible sounding equations? Well, we plug it into it. Current ratio, not complicated, is current assets divided by current liabilities. So that is 12 divided by 6 in this story that we've had. That will give you an answer of 2. Now, just leaving it as the number 2 is fine, and some people do it, but I don't like to do that. I like to, for the first time, actually have ratios in these ratio analysis things. So I turn it into a ratio very simply. We've got your answer of 2, and then all you do is put always ... to 1 afterwards. So instead of just saying I've got a current ratio of 2, I always prefer to say you've got a current ratio of 2 to 1. Now, what does that 2 to 1 mean? It means that James has 2 euros as a ratio for every 1 euro that he owes in the short term. 2 euros for every 1 that he owes in the short term. Now that's really useful because that's simplified, but this is as a ratio, as a proportion. So we've been talking about euros, but it now works across everything. If we said, well, hang on a minute, James owes imminently $1, doesn't matter because he's got $2 to pay it with. So this can work across all currencies. We can also do some quick calculations. Oh, I'm really worried about James, we could say. He owes Big Bill $1 million. If he owed Big Bill $1 million tomorrow, we would say, are we worried? That's a lot of money to owe this thug. Yeah, but don't worry, he's got a current ratio of 2 to 1. So if he owes Big Bill $1 million, well, he's got 2 million to pay him with. So no problem. If he owes 10 million, no problem. He's got 20 million to pay him with. So that 2 to 1 breaks it down simply and says, well, he's at no risk of not being able to pay his short-term debts. He's good in terms of his liquidity. Okay, let's have a look at some other people and let's introduce some others. We've got James up here. We're going to put a description to his number there. Now we're going to introduce Raj. Raj does a similar calculation and he's got a current ratio of 0.5 to 1. What do you think about that? Have a little pause, have a little think. What does that mean? Well, hopefully you figured out that's not looking so good. In simple terms, we can talk in euros again, or you can change to yen or rupees or whatever you like, but he has got 0.5 euros for every 1 he owes in the short term, under 1 year. So if he owes Big Bill €1, he's only got 0.5 of a euro, half a euro, to pay him with. And he's going to find himself in pretty big trouble to this scary person. Because Big Bill, you owe me the euro, what have you got? He does everything he can do, he's only got half a euro to pay him with. His liquidity is not good. In fact, the description of Raj, we would say that Raj is in, technical term, liquidity crisis. He does have a crisis as Big Bill approaches him saying you owe me a euro, because he's only got half the amount that he needs to pay him. So Big Bill's going to be angry. Now, let's look at Al and let's compare him to James. Who do you think's best there? Following that logic, if James has got a current ratio of 2 to 1 and Al's got a current ratio of 25 to 1, who's best? Well, hopefully you're screaming it was pretty obvious. Al is best. But no, if you've watched any of my videos, I always like to trick you. In fact, we wouldn't say Al was best. You're right though. What does it mean? He has 25 euros for every one that he owes. He's got, hopefully, no risk of liquidity crisis. He's safe. But in business terms, we'd say he's too safe. Come on, Al. Entrepreneurs, business leaders are about taking a risk. Why are you sitting on so much cash or stock? 25 euros for, you've got 25 times the amount that you need to pay yourself some debt. Get a bit more debt, take some risks, use that 25 euros to buy some non-current assets. Buy yourself a new van that can increase efficiency or a factory or something like that. That is just too safe. In actual fact, businesses would say 2 to 1 is optimum. We don't need any more than that. I would say, I don't know whether I like that. I'm not much of a risk taker. But if you've got €1 of debt, you're safe if you've got €2 in current assets to pay it. So generally the optimum, the most preferable for businesses is to work at 2 to 1. Okay, now let's move on in the story and let's go into adulthood, out of the school stories, and I'm going to introduce the character of Nervous Nick. Now, Nervous Nick heard that and he went, rubbish, I don't agree with what you're saying. I don't like taking risks. I want 25 to 1 as my current ratio. So he says, I know, that means I've got 25 current assets for every one that I've got, but it's his business and he wants to run it safely. So in January of running his business, he calculates his current ratio and he has 25 to 1 and he's very happy and feeling very safe. But lo and behold, in February, a couple of weeks later, he's in liquidity crisis. He cannot pay his current liabilities. He's got a problem. He can't pay his debts. The question, as I say at the bottom there, how? Have a pause again. How can this have happened when he was playing it so safe? How did this possibly happen? Well, hint on my screen. He sells, because I didn't tell you what business he did, he sells Christmas trees. Again, pause, because I'm going to give the answer away. Have a think. What's that got to do with anything? How does that create liquidity crisis? Well, let's go through. In order to do it, it's all to do with the fact of what current assets are made up of. Because I kind of been implying it's all cash, but if you remember at the start, it wasn't the cash of James, it was the cash plus his inventories, the chocolate bar. Now, if we look at Nick, Nick thought he was safe, but if you actually look at his current assets, he only had 500 in cash and he had 24,500 in Christmas trees. Okay, so he had 25,000 in current assets, 1,000 in current liabilities. That did give him the ratio of 25 to 1. But when whoever came to collect the debt, it wasn't that simple. So let's say Big Bill, adult Big Bill, turns up and he says, hey, you owe me 1 million. He suddenly finds, well, no problem, because I've got the current assets to pay it. But he doesn't, because the first thing he would need to do is liquidate his inventories. He'd need to sell his Christmas trees. But if you remember, it's Christmas and February, it's February in my story, and no one's buying Christmas trees in February. So it was wrong for him to be including, or it was not sensible for him to be including his inventory in his calculation of his liquidity. What he should have done, as you saw in my slide before I jumped through, is he should have poured acid over the top of his current assets. He should have really been critical of it, because in his business, he doesn't sell a product that you can always liquidate, that you can always sell off and turn into cash. Christmas trees are pretty seasonal. You're not going to sell them in February. Therefore, he should have removed it. And that is called the acid test ratio. It's the ultra safe option. It looks complicated. It's not complicated. It's the same one as well. It's just current assets divided by current liabilities. But this time, minus your inventories. Take it out. Don't presume you can always sell your stock, your inventory, because he couldn't. So if we look at that then, what happened in his, if we calculate it, he would have had 500 in cash, 24,000, but if we put it into the acid test ratio, he would have had 25,000 minus the Christmas tree's valuation, 24,500 divided by 1,000, and that would have given him an acid test ratio of 0.5 to 1, meaning exactly the same as the current ratio, that just more critically, he has 0.5 euros for every one debt he owes, and therefore he could potentially be in liquidity crisis. And he could have, if he calculated that in the first place, he could have acted upon it. That's it. Any questions, as ever, write them in the comments below and I'll try and make a video or explain it. It really helps me if you give a like and a follow. See you on the next video.